in this video, I'll be sharing some of my takeaways that I had from listening to the recording of Berkshire Hathaway's AGM. So let's dive right into it. Firstly is the Activision Blizzard purchase. So just some background info, Berkshire Hathaway actually purchased Activision Blizzard, which is a video game maker company, back in Q4 of 2021, and they started with a $1 billion stake. Then in January 2022, Microsoft announced a bid to purchase Activision for $95 per share, and Buffett said that he has no prior knowledge about this deal. And during the meeting, Buffett actually said that since Microsoft announced a bid to purchase Activision, it has become a different kind of security. And this strategy is known as a workout or arbitrage, which is something that Buffett used to do back in the early days of starting Berkshire. And at this moment, Buffett actually owns 9.5% of Activision Blizzard, and he has been adding on to his stake even though the share prices has went down. While Buffett acknowledges that there might be some regulatory obstacles regarding this deal, he still believes that this deal will succeed, and he also noted that one thing we know is that Microsoft has the money. Next, views on Bitcoin. We all know that Charlie Munger and Warren Buffett are not strong proponents of Bitcoin. In fact, they don't believe in Bitcoin as an investment asset class. They also maintained this stance during the AGM. So Buffett said that if someone offered him all the Bitcoin in the world for $25, he wouldn't know what to do with it, and thus he wouldn't accept it.
If you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, they have the same people, but it isn't going to do anything.
He also noted that Bitcoin is not an income-producing asset, which means that when you buy Bitcoin, you don't actually get income from it. Unlike when you purchase a farmland, you can get money from it because it yields crops, and then you can actually sell the crops for money.
Explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got now.
So what Buffett actually describes here is known as the greater fool theory. So the greater fool theory states that you can make money from buying overvalued securities because you can bet that there will be someone who is a greater fool who will actually be willing to pay for that security and willing to pay such a high price for that security. And what happens is that the market will eventually run out of fools left, and there will be a huge sell-off. So, you might be the unlucky one because you'll just be holding on to an asset, or rather to a security that is worthless. And Charlie Munger also added on to the discussion on Bitcoin, and he says that
in my life, I try and avoid things that are stupid and evil and make me look bad in comparison with somebody else. And Bitcoin does all three. and the first place, it's stupid because it's very likely to go to zero. The second place is evil because it undermines the Federal Reserve System and the national currency system, which we desperately need to maintain its integrity and government control and so on. And third, it makes us look foolish compared to the communist leader in China. He was smart enough to ban Bitcoin in China. With all of our presumed advantages of civilization, we are a lot dumber than the communist leader in China.
And moving on is about investing in China. So the Chinese government's policies and regulations have worried many US investors in the past 2 years. And Charlie Munger actually says that when he invests in China, you can get much better companies at much lower prices, so he's willing to exchange a little bit of risk for that. When asked about the macro outlook and on predicting inflation, here's what Buffett said. The truth is that nobody will know what the interest rate or the inflation rate will be, but some people like to speculate for prestige reasons just to make themselves sound smart, or they just like to speculate in order to make money. But what we do know for sure is that not all companies will be impacted the same. Some companies require far less capital to operate, and these companies will tend to usually fare well compared to those companies that are more capital intensive. And how about dealing with inflation? Buffett commented that inflation swindles almost everybody. It swindles the bond investors, the equity investors, and swindles anyone who actually just keeps cash under their mattresses, or in the Asian context, those who keep cash in the metal biscuit tin cans. Because inflation, what it does is that it reduces your purchasing power because your money actually erodes over time. Buffett's advice on how we can deal with inflation is that we have to be exceptionally good at something.
I'll tell something even better than that one stock. Maybe we'll get to one stock, but the best thing you can do is to be exceptionally good at something. The best investment, by far, is anything that develops yourself.
So just imagine this, if you're the best singer, dancer, doctor, whatever it may be, there'll always be someone who is willing to pay you and pay you well because you're the best at what you can do. And that value that you have can't be destroyed by inflation because the world will always need the best. And what Buffett actually says here alludes to the Japanese framework of ikigai, which is to find something that you're passionate about, something that can pay you, and something that the world needs. The final takeaway I have comes from listening to Buffett's investing journey and then also reflecting upon my own investing journey. So as we know, Buffett actually started out investing based on technical analysis. But then he had a great revolution, almost like an aha moment, according to what he says, when he read the book The Intelligent Investor, written by Benjamin Graham, and also mentored under him as a student in Columbia Business School. This was when Buffett's eyes were opened to the world of value investing, and ever since then, I guess he has never really looked back. And for me, when I just started out on my investing journey back then, when I was looking at the first few stocks to own, I was so attached to them. I literally thought that I would own these companies forever because they are the best in their industry, they're the best at what they can do. But little did I know that I was stuck in the trap of confirmation bias. I was seeking out evidence to believe that, this company is the best, and looking at news and everything to just confirm my own biases and beliefs. And I think this really taught me that I should be willing to change my perspective and take on a different perspective. Because if I were just to hold on these companies that are not anti-fragile, that are very prone to economic cycles and are very cyclical in nature, it will not be the best way to invest and put my money in, because there are much better alternatives elsewhere that can provide much more stable and less lumpy returns. And those are some of my takeaways from Berkshire Hathaway's 2022 annual meeting, and I really encourage you to watch the full annual meeting if you have the time. And there are just so many timeless concepts and wisdom that we can learn from Charlie Munger and Warren Buffett. And if you'd like to learn more timeless investing concepts, you can watch my other video over here where I share some timeless investing lessons that I've learned from the investing greats. I'll see you in that video.